Hello, everyone. Today on the Final Bar, I'm talking to Mike Zaccardi, joining us from Jacksonville, Florida. Share with us some of the charts that are top of mind for him. We'll talk about this market environment continuing to distribute. You had a lot of distribution yesterday. Today, Fed minutes came out earlier in the day. Quite a lot of choppiness afterwards, but not a lot of recovery, with the S&P down about 1%. Very much a defensive feel to the tape today, with utilities at the top of the list, consumer discretionary at the bottom. Ladies and gentlemen, this is the Final Bar. And welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down this market environment using the power of StockCharts, using technical analysis tools, the StockCharts toolkit to better understand the market around us, increase our market awareness, improve our awareness of the market conditions. You know, it's a choppy environment and a lot of quiet sort of early hours to the trading session today in anticipation of Fed minutes from the March meeting coming out. No real surprise, to be honest with you. And there's a bit of an up and down right afterwards. At the end of the day, no real significant move. While the S&P sort of finished in the middle of the range, you sort of had the same for the Nasdaq, down over 2%. So we continue to have this sort of defensive feel after the S&P attempts to get above the February highs, pushes above the 200-day moving average, pushes above 4,600. The Nasdaq testing significant resistance. We're settling down after that. So I feel like this is a market that pretty much frustrates everybody. We've rallied well off the March lows. So if you're bearish, you feel like you've been wronged by that move. And if you're bullish, the breakout that could have emerged has now phased out and filtered out. And now we're sort of in no man's land. We'll talk to Mike Zaccardi here in a little while and get his take on what we're seeing in the market. Tomorrow, by the way, on April 7th, we have Bob Lang from Explosive Options. All next week, you may pick up the excitement in my voice. It's because I have next week off. I'll be taking vacation. I always tell viewers and people that read my writings to focus on self-care and being mindful and taking breaks. So I'm listening to my own advice, taking a break with the family all next week. So we will be sharing 5 hidden features of stock charts every day at our normal viewing time. I'll give you a little snippet, something to dig into our platform a little bit better. There's so much great content coming out. We're going to do a segment a little later called Power Up, where I'll share with you one of the most recent additions called Scheduled Scans. Let's continue on with our market recap. Let's break down the activity in this market, this defensive feel to the trading day today, continuing yesterday's move. Let's get to the charts here. So the S&P 500 down about 1%, closing just above 4480. The Nasdaq Composite down just over 2%, similar for the Nasdaq 100. Mid caps and small caps down as well. No real cap theme necessarily to the returns. All were down about 1 to 1.2%. The VIX, by the way, back above 20, now just above 22 at the close today. Bond markets moving lower, so you have interest rates popping up a bit. The 10-year yield settled in right around 260. That's up from where we were at yesterday's close, around 255, 256. Dollar index essentially flat, but overall you've seen this resumption of the uptrend in the dollar. Really, I mean, I guess the dollar has had pullbacks along this way, but continuing to push higher. So when we're looking at this environment of higher interest rates, I'm immediately thinking of what that tends to mean for value stocks versus growth stocks. Now, can growth stocks outperform in an environment where yields are going higher? Of course they can, and it depends on your time frame. It depends on all the other conditions. It's not like those are the only things happening in the world. It's a mosaic of a lot of different inputs. But just remember, if you're buying growthy stuff now with interest rates most likely going higher, you are fighting a major headwind to growth stocks. They tend to underperform when rates are increasing. Commodity markets down, but really mixed, to be honest with you. The DBC was down about 0.8%, but gold and silver both up today. Silver price is up about 1%. The GLD has chopped around quite a bit after having a big spike higher, settling back in. Now sort of in that consolidation mode, that no man's land, that it feels like a lot of charts have sort of found themselves in. Where you're not seeing necessarily a lot of strength is in cryptocurrencies. All 10 of the most liquid coins that we track all down today. Bitcoin down about 3.5%, Ether down over 5%. And again, it's still coming off of fairly strong levels. So Bitcoin was at 47,000 just yesterday, now down below 44,000. But overall, this is coming out of the 30s where it was not too long ago. So again, nice rally off the lows, and now sort of chopping around to see what sort of further upside could be had there. Let's go to the daily chart of the S&P 500. My daily chart is kind of busy only because I tend to use the daily chart of the S&P like my ongoing daily conversation with the markets. I try to clean it up as much as possible for the show, but my own versions for my own use are pretty messy with notes and lines and all sorts of things to just remember what I'm thinking at any given day. And I always encourage people, don't treat charts like a picture that you're just looking at and thinking about. Treat it as a conversation that you have with the markets. Treat it like a workbook to capture your thinking. If you don't keep a trading journal, you should start doing that first. But once you get that going, use charts as a way to sort of understand what you're thinking. Then you can look back and actually see how you did over a period of time and what you saw and what might have led you into a particular trade that worked or did not necessarily work. The S&P 500 chart, again, if you're bullish, I would be concerned by what I'd call a failed breakout, right? The S&P, the Nasdaq, a lot of names like Apple faced significant resistance levels in the last week, and pretty much all of them have failed. You had the S&P, which actually closed above 4,600, which gets it above the February highs, but no real follow through, right? So follow through is you have the close higher, and then you move just a little bit further, and it's a sign that it wasn't just a fluke, because a lot of times you will have people waiting for a particular level, right? Waiting for an entry point or an exit point. You have them move, and then people make the trade, and all of a sudden, the market doesn't follow through. The market reverts right back lower. That's kind of what you see on the chart of the S&P 500. The gap above 4,600, the higher close, but then the immediate next day is back closing toward the lows of that two-day range. From there, the last week has overall been lower. You had one bounce higher during that period, but all the rest of these have overall been sort of flat to down. As of today's close, the S&P is back below its 200-day moving average. The RSI is back nearing the neutral 50 level, and you're starting to see some signs of weakness. I'd also point you, and we'll go to the next on the Mindful Investor Live chart list. And on Friday's show, we usually dig into this in pretty good detail. I just want to highlight this chart. This is one of my main charts to just think about breadth conditions. The S&P getting above 4,600 on a closing basis, rotating back lower now, closing back below the 200-day moving average. But look at the four measures of breadth using the advanced decline lines. Here's the New York Stock Exchange, then the S&P 500, so large caps, the mid-cap S&P index, and the S&P 600 small cap index. These are the advanced decline lines for each of those four different buckets of stocks. And look how all four of these broke above their February highs. All four of them, right? All four of them above their 50-day moving average. When those things happened, I changed them from bearish red to neutral orange, thinking, all right, at the very least, they're testing resistance and starting to break higher. That was sort of a 1 to 2 day thing for all four of these. All of them now rotating back lower. And so it's looking less like the market raging above resistance and pushing onward and ever upward to previous all-time highs. Now you have the major indexes and even mid-caps, small caps rotating back lower, and the advanced decline lines are pushing down. What's interesting about this, though, is as these advanced decline lines are rotating lower, I'm not struggling to find stocks that are working, and we'll finish off the market update looking at a couple individual stocks and looking at sectors as well. Charter Mosaic is one that comes to mind. We did a stock picking competition here at StockCharts TV, an informal, friendly competition picking stocks. Our technical director, Zach, came out with the victory, so congrats to him, his second one in a row. And Mosaic was his top performing name in his paper portfolio. And if you look, charts like this make you feel pretty confident that there are ideas out there. If you have money to put to work in equities, I'm not struggling to find stocks that are working. And it's things like Mosaic, it's what else? Like AbbVie, I'm thinking of even healthcare names and their names in energy. Bring up Valero or one of these names. There are stocks that are making new 52-week highs as we're debating the S&P and the Nasdaq testing resistance and all of that. So it's worth remembering that that this environment, if you think of stocks as the S&P and the Nasdaq, you're going to have one conclusion. If you think of it literally as a market of stocks, there are plenty of things that are working. You just have to find ways to identify those. That is a little teaser for the scheduled scans discussion we will have in a little bit later in today's show. Just very briefly talking about sector movements, fairly defensive play today, or defensive feel to the tape. So you have utilities, the XLU up 2%, healthcare and REITs both up about 0.5%, followed by consumer staples. So the four top sectors I would broadly paint as fairly defensive. Healthcare obviously has some different things in there, some more offense than defense, to be honest. But you really only own utilities and real estate and consumer staples if you're trying to hide out or ride out the uncertainty in other places as an institutional investor. The growthy stuff that had been leading out of the March lows, all at the bottom of the list, all down about 2% or more. Folks, that is our market recap. We'll take a quick commercial break. We'll be back with today's guest, Mike Zaccardi. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the market activity using StockCharts. A couple quick announcements before we get to today's guest, Mike Zaccardi. First off, we welcome your questions. We had a great mailbag segment yesterday on Tuesday's show. We'll do another one at the end of this week on Friday. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Knowledgeable guests like Mike Zaccardi, Kathy Donnelly from yesterday, some of the great discussions we've had in recent weeks on this market environment. Special events like Chart Madness, our upcoming StockCharts draft coming up later this month, and much more for free at StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Mike Zaccardi. Mike's an investment writer based in Jacksonville, Florida. He's one of the authors on our Top Advisors Corner on StockCharts.com. Mike, it's great to see you. Thanks for joining us on the show today.
Hey, thanks, Dave. Always great to be back with you.
So we appreciate you sharing some of the charts. I think a lot of investors are just struggling to get their head around this market, and there's just a lot of uncertainty, a lot of volatility. Every day seems to have another headline that can move things. You're starting us out in the fixed income markets, looking at credit spreads. What is this chart telling you?
Yeah, so I think this is one of the great indicators for the recession watch. You know, a lot of folks are breaking out their recessionary playbooks and just wondering if that's going to happen. You know, no one really thinks this year, although Deutsche Bank came out and said that yesterday that they see a recession. But really, you want to pay attention to credit spreads. So here we're looking at a chart of U.S. investment grade credit spreads, basically the yield premium of investment grade bonds over treasuries. And you see how it shot up there in late 2022, early part of this year. But then it really retreated. It pulled back about 60% of that increase year to date from the March peak to the recent lows. Now it's perked back up. In fact, the last 2 days on LQD, the iShares high grade ETF, that's gone down substantially, about 2.5% between yesterday and today. So we are seeing credit spreads tick back up. So that is definitely a barometer of some fear in the marketplace in the fixed income market.
Right. So higher credit spreads basically implies increased fear, right, or elevated fear. Your second chart, by the way, is the drawdown in the ag ETF. What about this one?
Yeah. So this is just such a fascinating chart. So if you go back in history of the iShares aggregate bond ETF, it just measures the total U.S. bond market. It includes treasuries, corporate bonds, investment grade junk debt. What we're looking at here is the drawdowns off of a recent peak, including dividends, but after inflation. So from the August 4th, 2020 peak in the ag, this thing is down bear market territory, almost 21% after inflation, including dividends, which we haven't seen anything like this in AGG's history. And, you know, we're probably looking at an historic year of losses for fixed income investors. And there's just hardly been any place to hide in the credit space, whether it's treasuries, corporate credit, short duration, hydration. It's been a bloodbath everywhere.
That's such a fascinating chart, and you wonder how people will react when their quarterly statements show up with big losses in bond funds, which I think a lot of investors are just probably unprepared for. Now, switching gears just a little bit for sentiment, we're looking at the AAII survey, which we talk about on the show pretty regularly. So share us what this chart is telling you.
Yeah, so this comes from the weekly survey data from the American Association of Individual Investors. What I did here was I averaged out each year's bull-bear spread. What this means is when you see a bar that's positive, that means there's more bulls than bears in their weekly survey data. When it's negative, there's more bears than bulls. And what this is showing is that so far, 2022 is the most bearish sentiment year on record in the survey's history. That goes back to 1987. So that's a pretty long way to go back. And people out there are just totally pessimistic on the markets. It's also important to take a look at positioning along with this, but this just tells you how uneasy investors are out there.
So investors are uneasy. We have concerns with bond funds underperforming. Where do we go here? Or where are you seeing opportunities? And if so, how do you ride out this sort of uncertain market? Is it commodities, which we didn't touch on, or where would you be looking for opportunistically, given the uncertainty we're seeing now?
Yeah, we are seeing relative strength, a little bit in energy. They've fallen off a little bit on the momentum scale. But like you have right there, we've got those defensive sectors, utilities, healthcare, real estate, performing pretty well. We have insurance companies, which are part of the financial sector, which has been hit hard recently. But insurers generally benefit from an overall rise in rates, whereas banks, they really depend on a steepening of that yield curve. So I would take a look at insurance companies. KIE is one ETF to monitor there. But there are some pockets of relative strength out there.
Mike, it's awesome to see you. And listen, you pack a lot of expertise into just a 5-minute discussion. I so appreciate you joining us on the show. Stay safe down there, and we'll talk to you again soon.
All right. Thanks, Dave. You bet.
That's Mike Zaccardi. Mike does a great job writing some content for our Top Advisors Corner. And by the way, he tends to spend some time focusing on financial advisors, how they can apply the technical analysis toolkit to better understand asset allocation and think about positioning. So I'd encourage you to look up Mike and his work if you're not familiar with it. Really thoughtful comments there from Mike Zaccardi. Let's continue on with our next segment, Power Up. I'm super excited to be in a position where I'm able to share with you new things, new features, new techniques that are being added to the StockCharts platform. As a management team, we've talked a lot about the StockCharts service and what we could do to upgrade it. And we have some really cool things planned through the course of the year. But it actually starts today. You're going to see this little green icon all over our website, hopefully more and more as the year progresses, with a little new button on there. If you look around, you'll find it starting to be peppered around in different places. I'd encourage you to check out those features because they're really some impressive capabilities. By the way, you can go to stockcharts.com/new to see what's new on the platform and make sure you're aware of the recent upgrades. What I want to do is share with you what are called scheduled scans. Now, we talk about the scan engine pretty often. So these are scans that I run pretty regularly, just members of a particular index, stocks making new highs or lows, stocks testing their upper Bollinger Band. There's so many different ways you can scan through our equity universe and try to make sense of it. And we have a scan workbench, which allows you to actually use a simplistic programming language if you're so inclined to create your own scans. I am very much not a programmer, and so I use the drop downs at the bottom where you can bring in some pre-canned scans as a starting point. You can bring in members of an index or an industry group or something like that, and use some of the common technical signals, buy and sell signals that are sort of best practices of technical analysis. Here's a really cool thing. Once you create a scan, we now have a new area of the platform called scheduled scans. What we allow you to do is actually run these scans offline and really on our servers anytime you like. So at the top, once you have a scan, your scans will all appear in this drop-down. If I select one of those, I can then go to when I want it to run. And we have sort of the major opens and closes of the different major global markets that we track, but you can put in a custom time if you'd like to do so, and then you can decide what you want to do with the results. So you can see here, as you add scheduled scans, you'll see them listed below where you're able to create the scan. I have 4 of these that literally run every day at the market close. what stocks in my universe are making a new 3-month high? What stocks are making a new 3-month low? What ETFs are making a new 3-month high? What ETFs are making a new 3-month low? Those run automatically every day right after the close Eastern time. They are emailed to me, so I can look at my email. I can quickly scan the results. They're automatically put into a chart list. So I have a chart list for each one of these that just is always showing the most recent results of those scans. So in a chart list on ACP, you can just always bring up the results of this scheduled scan. So if you have a good way to identify opportunities, automate that, put it as a scheduled scan, and you can have StockCharts do some of the legwork for you. That's our segment powering up. Power up. Let's go to our next one, ETFs engage. I want to talk a little bit about home builders. So the home builder index, there are a number of different ways we can track home builders. I tend to use two ETFs, the ITB and the XHB. The two of them are fairly similar, and a lot of people use them interchangeably. And it's funny, if you look over time, you will find some differentiation in terms of the performance profile, or how the returns over time, because they do have some different components to them. ITB is one of them. That's the iShares Home Construction ETF. The other one that I've used pretty regularly is the S&P Spiders Home Builders ETF, which is ticker XHB. Now, between the two of these, they're very similar. They have a lot of the same names. There's plenty of overlap. The ITB, this first one, is a little more heavily weighted to the traditional home builders. So DR Horton is about 14-15%. Lennar, NVR, Pulte Group. Those four are probably 20, 35, 40% of the ETF, I would say. Compare that to XHB, was a little more equal weighted. So you're going to get a little more of the performance of the home builder sort of related ones, things like Restoration Hardware or Masco, things making, industrial supplies and those sorts of things related to home construction. So ITB is more pure home builders. XHB is a little more home builders and home builder-like securities, I guess is how I would describe it. Both of these, unfortunately, are showing a deterioration in performance. And that's what I want to highlight. Regardless of what the weightings are, and I would say the challenge for homeowners, the interesting thing is home prices are going up so significantly. So I've had some people that have asked me, home prices are ripping through, and here in the Seattle area, I know in other areas, home prices have just gone vertical in a lot of ways. The question is, how can I play off of that? Home builders are not actually a great way to do that right now, and the problem is the prices are going down. There are a lot of reasons we don't have time to go into, sort of outside the scope of the show. I would remind you, though, that a narrative like home prices are going higher, which means home builders are probably a good bet, is a really simple narrative that I would not bet the house on. I would focus on the charts, which will tell you whether that narrative is working or not, right? Are home builder prices going higher? Now, the major names are the ones that I mentioned, DR Horton, Lennar, NVR. We'll look at a couple of those here in a moment, but as a quick preview, most of them look a lot like the charts of ITB and XHB. All of these ETFs had a nice run in 2020 to 2021 into the first, maybe the second quarter. From there, a lot of these stabilized. And here we were talking about home builders, and I know for my Market Misbehavior Premium members, we were highlighting some of the home builder names that were rotating higher in the fourth quarter of last year. XHB is making a new high at that point, a new 52-week high. Here's the ITB. You can see also making a new 52-week high. Pretty compelling. Here's the problem. They made a new high and then never went any further. That resistance of around 82.50, 83 on ITB has pretty much been the peak. From there, we had a series of downward moves. And I never have I never mind. I'm always excited to point out stocks that are breaking out and ETFs that are breaking out, because more often than not, breakouts lead to further strength. That's what William O'Neill and other growth managers will tell you, that market history is full of stocks that did well and then continue to do well after that point. It's not just they just went from zero to, went vertical. They had some trends that evolved over time. That's the essence of trend following. But you also have to have part of your toolkit that allows you to recognize when it's no longer working. And I think these breakouts that happened in the fourth quarter really rolled over once January hit. End of last year, they're looking pretty good, but never broke to new highs in 2022. From there, we've now seen a pattern of lower lows. We've seen a pattern of lower highs. I think the most damning evidence on this chart, after we broke below the 50-day moving average there in January, we keep making lower highs. And every bounce higher, even though the stock bounced or the ETF bounced a number of times, never really able to regain the previous high. Now we've actually undercut, made a new 52-week low again this week, going back to March of 2021. The momentum is overall in a negative configuration, well below 50, and the relative strength has continued to push to the downside. So, as Tom Bowley, one of our fellow commentators, would always say, if you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. Homebuilders are just not it. And if you look at the last 4 months, it's been struggling while other areas of the market, some of the ones that my guest Mike Zaccardi were mentioning, good examples of that feature, of sectors and stocks that are actually doing a little bit better. So homebuilder ETFs, again, the two most common ones would be XHB and ITB. They do have some different weightings, and I'd encourage you to do the due diligence when you think about things like expenses and spreads and assets under management, general liquidity, the volume, to understand an ETF. Also look at the weightings and see what sort of exposure you get. The two of these provide some different looks at the homebuilder space, XHB and ITB, both of them struggling. And the main reason, just to finish up the segment, is if we look at the individual stocks that make up these ETFs, you can see why the ETFs themselves are struggling. Here's Lennar Homes, which showed up on my new swing lows list that I was sharing with my premium members earlier today. Let's see, DR Horton is DHI. You can see a similar look there. NVR, and I don't need to go through any more. They all look very, very similar to that. So the lesson here, number one, do your due diligence. Understand what exposure you get from some of these ETFs. Just because it says home builder in the title, make sure you understand the components, the construction of it, along with the rest of your due diligence on fees and so forth. Also, pay attention to the different weightings you could get from different ETFs that cover the same space. But most importantly, don't get caught up in a narrative like higher home prices mean higher home builders. Focus on the charts. The charts will tell you whether or not that theme, that idea, is actually playing out. We need to wrap today's show and go to the 3 in 3, 3 charts in 3 minutes. Let's hit on some of the key charts of the day. And we're actually going to keep it pretty simplistic and look at 3 sectors. When I'm looking at the relative strength in this market, I'm looking at today and yesterday. We have the market rolling over. You have a very defensive feel. I'm immediately going to 3 sectors automatically. When people say the market's struggling, I immediately think of 3 sectors which tend to be overweights or good overweights when the market is struggling. The first one's utilities. The XLU, as we saw today, was the top performing sector out of the S&P. Faced resistance in March, tested the resistance from January, broke above it, and it's pushed higher. The relative strength making a new 12-month relative high today. Utilities currently overbought. That doesn't concern me a ton because when a market is strong, you will have those overbought conditions. So if and when it comes out of that overbought region, you could expect a bit of a pullback, and that's what I'd be looking for on some of these sectors that have all of a sudden emerged in a position of strength very quickly. However, in general, following strength has tended to be a pretty decent trend. The relative or the price performance in the XLU has been fairly strong. The improving relative strength is what's most important to me there. Chart number 2, real estate, the XLRE. One of my guests, I think it was last week, David Auerbach, did a great job. And if you missed that interview, go back to StockChartsTV.com. You can hear my discussion with David Auerbach. We talk about some residential REITs, including CPT, Camden Property Trust, which showed up on my new swing highs list earlier today as well. Real estate, again, making a new 12-month relative high, not quite above new highs for the year, but getting closer and able to power above its February high. So while the S&P, the Nasdaq have not done so, look at how real estate is actually powered to the upside. The last one is consumer staples. We talk a lot about the consumer discretionary to consumer staples ratio. It is very much favoring consumer staples in the last week or two, as consumer staples have started to outperform, as consumer discretionary, the XLY has rolled over. Again, consumer staples tend to be things you need as opposed to things you want. But when the markets get choppy, you still need toilet paper, and you still probably need beverages of some sort and other things. And that's what you're playing on here, playing with things that are sort of recession-proof, maybe is not the right word, but something kind of like that. So when things get uncomfortable, you still need to pay for those things, those household goods and other personal necessities that are in consumer staples. So those 3 sectors all could provide some opportunities, and the price performance and the relative strength are turning higher on all 3 of those. In general, I would be looking for areas of the market that are outperforming. Those are 3 examples, certainly playing that out. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close for the final bar. All of our previous interviews and discussions are at StockChartsTV.com. Special thank you to Mike Zaccardi joining us from Jacksonville, Florida. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.